All right, friends, let's start getting into the thick of things. Let's start with liquidity ratios. So liquidity ratios, as we said, basically gives you an information, it tells you about whether the company has enough assets to meet its short-term obligations. And it's generally based on the relationship between the current assets and current liability section of the balance sheet. Under liquidity ratios, there are three key ratios that you will hear about and that you will need to be aware of. And these are mentioned on this table. These are the current ratio, the quick ratio, which is also known as the asset test ratio, and the cash ratio. Basically, the current we'll just discuss all these briefly. The current ratio is the most simplest ratio and tells us whether the company can meet its current obligations, whether it has enough assets to meet its obligations, and is clearly defined as current assets by current liabilities. Now, if your current assets is more than current liabilities, this ratio would be more than 1. And subsequently, if current assets are less than current liabilities, this ratio would be less than 1. If you remember, in your balance sheet lecture, we had talked about the concept of a working capital, which is known as current assets minus current liabilities. So hence your working capital would be positive or negative based on whether this ratio is more than 1 or less than 1. Now, a higher current ratio essentially means that you have enough assets to cover for your liabilities. But on the other hand, it could also mean that you are not using your assets most efficiently, and you have actually locked your money into assets which are not generating revenue or are not generating enough future wealth for your company. So you have to keep that in mind. I'll just give you an example that there are a lot of these FMCG companies in India, and most famously HUL, the Hindustan Unilevers, where the company has actually negative working capital, where the current liabilities are more than the current assets, and that's because it can afford to delay its payments to its suppliers, while its customers are more than willing to pay for its products upfront. As a result, it has if you were to just go by if you were just to go by the book, if you were to just go by with the fact that current assets should always be greater than current liabilities, you might consider that HUL is not performing it's a high risk company. But the fact is that it's actually a very efficient use of financial management that is helping HUL having current liabilities more than current assets. So those are some of the factors you need to keep in mind while looking at the current ratio. The quick ratio is a modification of current ratio. When you look at the current assets part of a balance sheet, you have items like cash, inventories, accounts receivable, the prepaid expenses. Now, the inventories is what we are going to discuss as far as quick ratio is concerned. All the other items that are there in the current assets can actually be converted into cash immediately, but inventories can't be done. Inventories cannot be converted into cash in the immediate term. So that's why we have this concept of quick ratios, because basically from the current assets we exclude inventories, and then we take the ratio of the current assets with current liabilities to understand how quickly the assets can be converted into cash to meet your short-term obligations, where the assets don't include inventories in the analysis. Finally, we have a cash ratio. It's again pretty straightforward. It's basically the cash at hand and the marketable securities, because within the current assets, this is essentially the cash that you have, and this can be converted into can actually be immediately liquidated to meet your current liabilities in a very, very short amount of time. So that's why we have this ratio of cash ratio. But even if cash ratio is very small, it may not be. It doesn't mean that the company is weak and we need to be worried, because you can always have time at your hand, because you can always stretch your payments or borrow money in the short term to borrow more money to meet your short term obligations. That's why this ratio is not that important.